So I built an autonomous trading agent, gave it $100,000, let it trade through a 6-month bear market. It made 5 trades, lost all 5, 0% win rate, every single closing trade, red. And it still beat the S&P 500 by 15 percentage points. I can show you exactly why. Because I built a decision journal into the system that captures what the agent was thinking at every step, not just what it did, why. And the reasoning logs tell a story that has almost nothing to do with trading. Quick context, the system is called Tradecraft. It's open source, you can go look at every line. The setup is pretty simple. The agent gets a portfolio snapshot, market data, technical indicators. Every cycle, it decides to buy, sell, or hold. No human in the loop. But here's the part I think people miss about these kinds of systems. The risk limits aren't in the prompt. They're in the code. If the agent tries to buy $50,000 of something, the infrastructure rejects it. Doesn't matter how convincing its reasoning is. Hard limit. That distinction matters because you'll see a lot of AI trading projects where the safety is just a line in the system prompt saying, don't risk too much. That's not safety, that's a suggestion. And then the decision journal. Every cycle, the system logs what the agent decided, what signals it saw, what it was weighing, what biases it might be exhibiting. Without this, you just get a returns number. With it, you can trace the psychology. You can actually see the agent think. I ran this through 2 stress tests, 2 of the worst periods in recent market history. The first one went well, the second one is where things got weird. January through June 2020, the COVID crash. The S&P dropped 34% peak to trough. If you were paying any attention to markets during this time, you remember? Pure panic. Nobody knew what was happening. The agent returned 6.45%, max drawdown 4.7%, Sharpe ratio of 3.93. Good numbers. But I don't really care about the numbers, I care about the behavior, because something happened during this test that I wasn't expecting. Between February 24th and March 9th, the market is in freefall, and the agent does something that humans almost never do. It sells 4 positions in a row, all at a loss. AAPL, GOOGL, AMZN, MSFT, one after another. Total cost about $3,000. Now, there's this pattern in human trading called the disposition effect. People hold their losers too long and sell their winners too early. Odeon published a study on this in 1998, found that individual investors are about 50% more likely to sell a winning position than a losing one. And it's not because they're dumb, it's because locking in a loss feels like admitting you were wrong. You know this intellectually, you still do it, professionals still do it, the bias is deeper than the knowledge. The agent just doesn't have that. It saw conditions deteriorating, it cut 4 times, moved to cash. No hesitation, no maybe it'll come back, no ego in the decision at all. And then the part that surprised me, after going to cash on March 9th, the agent sits there, does nothing for almost a month. The market bottomed on March 23rd. The agent didn't buy back in until April 6th. 2 weeks of missed recovery. Why? I pulled the journal, and it's right there in the reasoning. The agent keeps referencing its own loss streak. 4 of last 5 trades were losses. It starts demanding multiple confirming indicators before it'll enter anything. Meanwhile, the market is screaming oversold. RSI on SPY hit 26. Everything is flashing green, but the agent's recent track record is overriding what the data is telling it. That's recency bias, and it matters because it shows you exactly how these models weighed their own history. The recent past dominates, 4 bad trades, and the agent gets scared, not of the market, of itself. Quick math though. The disposition effect avoidance saved roughly $25,000 to $29,000. The recency bias cost maybe $5,000 to $10,000 in missed gains, net positive, by a lot. So 2020, agent looks disciplined, has some soft spots, but the wins outweighed the mistakes by a wide margin. Then I ran 2022, and honestly, I almost didn't publish the results. January through June 2022, inflation running hot. Fed hiking rates, no V-shaped recovery coming, just a slow grinding decline where everything gets a little worse every week. The agent lost 5.22%, max drawdown 5.78%. The S&P lost 20.6% with a max drawdown of 23.6%. Win rate 0, 5 trades, 5 losses, every single one. And I want to be honest about how that looks. If someone showed me a system with a 0% win rate, my first reaction would be, this is broken. That's the normal reaction. But the story underneath that number is way more interesting than the number itself. So here's what happened. For the first 8 trading cycles, nearly 2 months, the agent sat in 100% cash. 8 consecutive decisions to do nothing. I'm watching this play out cycle by cycle, and the agent just keeps saying no. Mixed signals, not enough confirmation, hold. The market was already correcting during this time, so doing nothing turned out to be the right call. But the decision journal is honest about why. For the first few weeks, the agent literally didn't have enough data to generate its indicators, and when data did come in, everything was mixed. So it waited. I'd love to tell you this was brilliant foresight. It was mostly the agent being unable to make up its mind, but the result was the same, capital preserved. Then March 2nd, the agent finally enters, MLFT SPYAMZN, commits. A week later, it cuts AMZN at a loss, market dropping further, fine. That's discipline, same pattern we saw in 2020, but then the relief rally starts, MSFT and SPY recover. AMZN bounces 19% off its low. The agent sees 3 confirming bullish signals on AMZN and buys back in on March 30th. This was the mistake, and I keep coming back to this moment because I think it's the most revealing thing in the entire experiment. That rally was a dead cat bounce, temporary, and the agent fell for it. It saw short-term momentum, saw the technical indicators that the bounce created, and read a temporary recovery as a trend change. It didn't see the bigger picture. Fed tightening, inflation still hot. Those technical signals by construction lag reality. They told the agent what already happened, not what was about to happen. This is anchoring. The agent locked on to recent price action and the bullish signals it generated and missed the macro context entirely. By April 6th, it was fully positioned. A APL, AMZN, MSFT, SPY, all in, heading straight into the second leg down. Then the slow bleed. April through May, every position just grinds lower. Day after day, the agent held for a while, then started cutting. AMZN at negative 13.1% on April 28th. APL and SPY on May 5th after the Fed hiked 50 basis points. ESFT, the last one standing, on May 26th. Portfolio at $94,783. And then for the last 5 cycles, the agent sat in cash again. The market bottomed on June 17th. The agent was on the sidelines, already locked in its loss, 0 wins out of 5. That's bad. I'm not going to spin it, but zoom out for a second. Look at the drawdown numbers. The agent's worst dip was 5.78%. The S&P's worst dip was 23.6%. The agent was in cash for 13 of 25 trading cycles. It didn't beat the market by being smart. It beat the market by not being there for most of the damage. Okay, I know what some of you are thinking, probably already typing the comment. Claude was trained on data that includes the COVID crash and the 2022 bear market. It already knows what happens. Of course, it sold before the bottom. It's not making decisions. It's pattern matching on history. It's already seen. Fair, and if that's true, none of this means anything. So let's look at it. If the agent knew what was going to happen, the results would look completely different. The market bottomed on March 23rd. If Claude had foreknowledge of the COVID crash and recovery, it would have bought on March 23rd, maybe the 24th. Instead, it waited until April 6th. 2 weeks late, and the journal tells you exactly why. It kept referencing its own loss streak. It was demanding extra confirmation. That's not an agent that knows the future. That's an agent that's spooked. It fell for the dead cat bounce. If it knew the 2022 timeline, it would never have bought AMZN at the top of a temporary relief rally. It would have stayed in cash until June. Instead, it got suckered in by short-term technical signals, went fully positioned, and rode everything down for 2 months. 5 trades, 5 losses. That's what foreknowledge looks like. And there's a structural thing here. The agent doesn't get a prompt that says you're trading in March 2020 or this is the 2022 bear market. It gets prices, indicators, portfolio state, one cycle at a time, no dates, no historical context. It's seeing the same data it would see on a live feed. The mistakes are the best evidence against the foreknowledge argument. An agent that knows doesn't get spooked by its own loss streak. An agent that knows doesn't anchor on a dead cat bounce. The specific ways this thing fails only make sense if it's actually reasoning through uncertainty, not replaying something it's already seen. So no, I don't think this is memorization. I think this is an LLM making real decisions with imperfect information. And the behavioral patterns are measurably different from what you'd see with a human in the same seat. Okay, so here's where I want to land. The trading stuff is interesting, but it's not the point. The agent can't predict the future. 50% win rate in 2020, 0% in 2022. If prediction was the game, this thing is useless, but prediction isn't the game, and I think a lot of people miss this when they look at AI systems. The question isn't, can it be right more often? The question is, when it's wrong, how does it fail? Because the decision journal shows that LLMs fail differently than humans, and the way they fail turns out to matter more than how often they're right. When a human trader takes 4 losses in a row, one of 2 things happens. They revenge trade trying to make it back fast, or they freeze completely, can't pull the trigger on anything. The agent did neither, it went to cash. Waited. Not perfectly, it waited too long. But the failure mode was excessive caution, not self-destruction. When a human fund manager is sitting in 100% cash for 2 months while the market is moving, they feel it. Clients calling, board asking questions. Why aren't we doing anything? That pressure is real whether the decision is right or wrong, and it pushes people into bad trades constantly. The agent has no career, no ego, no board to impress. It just sits there until its conditions are met. Nobody's calling the agent asking why it's underperforming this quarter. And here's the part I keep thinking about. The agent's mistakes are fixable. The recency bias, you can probably address that with better prompt design. Give it a longer look back on its own performance so a 4-trade losing streak doesn't dominate the reasoning. The anchoring on the dead cat bounce, give it macro data, interest rates, inflation numbers, Fed statements, not just price and volume. These are problems you can work on. Ship a fix, test it, iterate. Human biases aren't like that. Loss aversion, the disposition effect, hurting ego, these aren't bugs. They're how our brains work. Millions of years of evolved psychology that made perfect sense on the savannah and makes terrible sense in a portfolio. You can train a trader for 20 years and they'll still feel the pull to hold a losing position. You can know about the disposition effect, read Odian's paper, understand exactly what's happening to you, and still do it. The wiring is in the hardware. You can't ship a patch for human nature, and this goes way past stock markets. Think about any domain where someone has to cut losses or sit patiently or ignore sunk cost when every instinct says do the opposite. Corporate budgets, venture capital, hiring, resource allocation. Trading is just where I could measure it. The behavioral pattern is the same everywhere. I'm running a multi-model tournament next, Opus, Sonnet, and Haiku. Same starting conditions, same data, identical portfolios. Here's what I want to know. If the cheapest, smallest model still outperforms average active managers, then the edge isn't about raw intelligence, it's about forced discipline. And if the edge is structural, if it comes from the absence of ego rather than the presence of skill, that changes how you think about every domain where LLMs are making decisions. Not just finance, all the code is open source, link in the description. The decision journal is queryable. You can pull every trade, every reasoning snapshot, and check everything I've said here.